to share what people are expecting from today's meeting. And then also the team have also relaunched the A-share sentiment index. Also another interesting thing to cover is the observations from Chinese companies who have already reported in the third quarter earnings season. So now let me hand over to Chloe.
Yeah, sure. Thank you, Crystal. So first on the U.S.-China meetings, the two presidents are meeting now. And before the meeting, we see that yesterday, the President Trump already mentioned that he's considering to reducing the fentanyl tariff. And also the NVIDIA chips will be part of the meeting agenda. And on the China side, we see China stated that some basic agreement was reached on the fentanyl control, the maritime shipping, agricultural trade, and also export restrictions. So with all this, we think the market did not expect the fentanyl-related tariff reduction in the near term, although they think the 100% additional tariff is unlikely. And we see that actually MSCI China has underperformed the S&P 500 by 5 percentage points since October the 10th. So if the combination of these above measures could be confirmed, we expect it's a positive lift to the Chinese market with around a middle single-digit lift at the index level. And secondly is on the Asia sentiment. This week, we launched our MSASI, which is Morgan Stanley Asia Sentiment Indicator. So for this one, actually, we first launched it in 2019, and it's a comprehensive indicator to track the Asia sentiment. And since then, we have published on the weekly basis. But currently, given the evolving market structure and data availability, we are relaunching it this week. So what's new in this MSASI? We basically include 12 metrics in this indicator. So for the new metrics, we added first one is a Shanghai Exchange new registered account, because the previous new registered investor data has been suspended disclosure for some time. So we are replacing it with a Shanghai Exchange new registered account. And secondly is that we include two metrics on the short selling sentiment, because that in Asia market, a lot of stocks are not easy to short directly. Investors normally use the index level futures and options to hedge. So we include the two metrics to gauge the short selling sentiment. The two metrics, first one is the CSI 300 backwardation, which looks at the CSI 300 future price versus the spot price. And the second one is the CSI 300 core put ratio, which looks at the outstanding balance of the core put ratio to gauge the short selling sentiment. And the third one, one new matrix is on the flow side. We know that the northbound net flow data had suspended disclosure since October 2024. So here we include an alternative data, which is foreign passive fund flows to CSI 300 to gauge the foreign investors' fund flows to the Asia market. So currently the new MSAs include 12 metrics in 4 categories. The first one is turnover. We include turnover in Asia main board, the Chinese, and also equity futures, and also including the northbound. The secondly is on the market sentiment side. For this one, we include like for margin transaction balance, the new account registered, RSI, and also number of limit up A share. And the third one is for the short selling sentiment. Just as I mentioned, we include the CSI 300 futures backwardation and also the core put ratio. And the fourth one is on the flow side. We include the foreign domiciled passive fund flows to CSI 300. And then lastly is on the fundamental side. We include the earnings revision breadth to gauge the earnings revision trend from the analyst. So basically, we standardize the 12 matrix with this 100-day moving min-max and assign weightings to the 12 matrix according to their correlation with CSI 300. So as a result, we come up with 2 indicators. The first one is MSASI. This is the yellow line. And the second one is the 1 month moving average of MSASI, which is the red one. So for the yellow line, it's more like a real-time indicator. And for the second one, the red line is more smooth. It's more like a broader trend. So with this MSASI, we also launched our trading strategy. So for our trading strategy, we basically look at the red line, the 1 moving average of MSASI, and we find that when the indicator falls to 22% and below, it suggests that the market has become too weak, and it often coincides with oversold conditions. So our strategy is to buy CSI 300 when the indicator reaches 22%, and we hold it for 70 days. And for this, it will generate a cumulative return of 91% with 67% hit ratio since 2014. And on the other hand, we see that when the indicator reaches to 78% and above, it indicates overheated market sentiment, and the market may correct or consolidate since then. So our strategy is to short CSI 300 when the indicator reaches 78% and also hold for 70 days. And for this, it will generate a cumulative return of 31% with 60% hit rate since 2014. So the current Asia sentiment we see is standing at around 77%. Actually, it has surged from the June 2025 level and peaked in late September, but now it has been cooled down. And it still remains at the elevated level, but has normalized from the overheated level. So at this stage, we recommend a balanced stance, focusing on the earnings quality and also fundamental resilience. And lastly, very quickly on the third quarter results. From the Asia pre-announcement, we see that the Asia pre-announcement was still net positive in the third quarter, with a net 1.7% of Asia's posted positive pre-announcement, but with a small sample size. So only 3% of companies have released it. On the earnings trend, we see that the 2025 consensus earnings have shown a downward trend in the past 2 months. It's mainly dragged by some large cap internet companies, which are involved in the price war. But if we look at the 12-month forward EPS trend, it's more resilient. Given market effects, the fast delivery price war may peak in the third quarter and will gradually normalize in 2026. And for sectors, we see several sectors have a stronger upward earnings revision in the past 2 months, including insurance, financial services, and materials. With that, I will stop here and pass it back to Crystal.
Thank you so much, Chloe. And now we are zooming out, and then we are looking at Asia trade deals. We have Jonathan Chung from the Asia Econ team as well today to share the read across of the Asia-US trade deals and the impacts on export inflation, and also on the note on which economies will have more impact by China deflation.
Great, thanks, Crystal. Yeah, so just firstly, zooming back out, just on what recent trade deals in Asia mean for the broader Asia exports outlook and growth outlook. So over the past week, apart from what my colleagues have already mentioned on Korea and China deals, the U.S. has also finalized deals with other Asian economies, including Malaysia and Thailand. And President Trump has also said that the U.S. will have a trade deal with India soon. So we think that taken together, these recent developments are helping to lower uncertainty in the economy. The potential reduction in tariffs on China is also an upside surprise relative to our economic base case. And media is also reporting that India tariffs could potentially be lowered closer towards maybe the 15 to 16% range at the headline level. So, incorporating lower auto tariffs also in Korea, as well as China and India's tariffs, the U.S. weighted average tariff rate on imports from Asia would have been lowered by 5 percentage points to 20% at the aggregate level. Now, what this means for growth is that, as Kathleen also alluded to, we could get some modest recovery in the regional non-tech exports. So far what's played out year to date is that tech exports have been really the sole support to overall Asia exports, notwithstanding trade front loading. non-tech exports, which is about 75% of Asia's export basket, that slowed to just 3% year on year in August. So this narrow export strength has also meant that really the positive spillovers that you would get from exports to the broader economy, like job growth, and also spillover to consumption, and also non-tech investments, those have been really quite limited. So looking forward, while in the near term, we do expect still some continued weakness in non-tech exports, mainly from the payback from earlier rounds of trade front loading. But as we get closer to early next year, with this higher certainty now on tariff levels that we've received from the trade deals, and as the effects of monetary policy easing kicks in to support domestic demand, not just in Asia, but also in the US, we do expect a modest recovery in non-tech exports starting early next year. And I think what that would mean is that you would also have that spillover now towards non-tech capex and also job growth. So you will get a broader economic recovery here in Asia from next year onwards. Now, so that's on trade deal and its impact on Asia's growth outlook. Moving on to the second topic, which is covering our latest report on China's deflationary spillover to the rest of Asia. I think in this report, we're really trying to answer three key questions here. Number one, sort of what is the progress on China's efforts to exit deflation at the sector level since anti-involution efforts began in the middle of the year? Number two, what we've also seen over the past year is that with trade tensions, you've had China's efforts to export more to the rest of the world outside of the US being accelerated, and especially in its exports to rest of Asia. So with China exporting more, it's also exporting more of its own deflation. So which economies and sectors in Asia are more exposed? And here in this note, we've developed sort of a new framework to just assess that. And I think lastly, what are the implications for the rest of the region, especially with regards to monetary policy? Now in question one, we've really been of the view that anti-involution efforts can be successful for select sectors, but that success at the aggregate level will take time. So in this note, we've looked at China's PPI data in detail across 18 sectors. And what we've seen is that while commodity-related sectors have seen some price stabilization, as you can see here in the yellow line here, 13 out of the 14 non-commodity manufacturing sectors have actually continued to see sequential price declines in the last 3 months. And what's more is that, the pace of decline is at a similar pace as before in the first half of the year. So what the kind of micro sector level data is reaffirming to us is that at least at the sector level, progress on reflation has been somewhat limited so far. Now on two, even as China is exporting less to the US, its accelerated push to exporting to the rest of the world has meant that China's trade surplus over the past year has actually increased by over $300 billion to $1.2 trillion currently. Now, part of this success is also because of export price cuts by Chinese exporters. So aggregate China export prices have actually declined by 4% in the last year. And this is meaning that there is overall more deflationary spillover via the trade channel for rest of Asia. And already we are seeing some increasing synchronization in China's non-commodity PPI with the rest of Asia's non-commodity PPI pricings. And we think that if we look at it from a sector basis, the spillover is going to be most intense in the sectors where China is in deeper PPI deflation. So here in this left-hand side chart, so sectors where China is in deeper PPI deflation, but also the same sectors which have also contributed the most to the increase in China's trade surplus over the past year. So basically sectors which are closer to this top left-hand side corner. So sectors like motor vehicles, electrical equipment, and we've also looked at it one kind of level downwards in terms of details. And kind of within, electrical and computer electronic products, we're also seeing specific sectors like battery manufacturing, TV, and also audio visual equipment, household electrical appliances, and power transmission and distribution equipments are the sectors which we're seeing China export the most deflation in. So which within rest of Asia, apart from a sector level look, which economies are more exposed? And in this note, we've developed sort of a new framework which combines the use of both trade and PPI data to identify the specific economies where we're seeing this spillover coming through more evidently. And here we see kind of 4 metrics measuring the extent of deflation driven by China, the trajectory, the breadth of sectors covered in deflation driven by China. And then the last one would be competitive export price pressures coming from China. And we do this by kind of comparing how similar each Asian economy's export baskets are to China's. So as China persists in deflation, you will get this competitive pressures that come more for exporters which are in direct competition with China. So overall, we see Thailand, Malaysia, and also Korea as the most exposed based on our framework within the region. And we see that, the likes of India, Taiwan, and also Indonesia, they are more moderately exposed. And lastly, Japan and Australia would be the least exposed out of this framework. And just finally, so what are the implications for rest of Asia? We broadly think that, China's deflation and its continued search for an alternative market to the US, accelerated by this medium-term multipolar world dynamics, will continue. And that's going to keep Asia ex-China in a low-inflation environment for longer. We think that, this deflationary spillover at the moment is somewhat less appreciated by markets. So inflation in rest of Asia will likely surprise on the downside. What that means for monetary policy is that central banks in the region will cut more than what markets are currently pricing. But I think one thing is that this deflation also has been keeping real rates higher relative to historical levels. So while we will get some rate cuts, some more rate cuts than what market is pricing, I think at the same time, this kind of suppressive effect on domestic demand will be more evident, especially in economies which earlier we pointed out to be more exposed. And incidentally, some of these more exposed economies are also where, if you think about monetary policy space, for the likes of Thailand, they're comparatively more restrained, and so they will face more headwinds. So yeah, this is our broad-based conclusions on this report. Let me hand it out back over to you, Crystal. Thanks.
Thank you. That's super clear. Thank you so much, Jonathan. And lastly, just want to touch on the report that we just published on Asia EM earnings this morning. So in terms of the overall setup, we have seen a very encouraging earning revision trends overall in Asia, and especially in Japan. So the ERB in Japan has risen to 5.7% from negative territory in May to August. And we have also seen improving trends in Australia, Korea, Taiwan, and China, while Eastern Europe and UAE are still very positive. So the key stories that we are watching, firstly, is the AI capex. Secondly, is the economic security beneficiaries. And we are also watching for evidence on the AI monetization. At the same time, we are also remaining bullish on M&A outlook into 2026. So in this report, we have developed the same set of screenings as the last report in August. And these are based on the preview to earnings tool that we have in-house. So the first screening is on the expected beats and raises. For example, it has Samsung Electronics that are expected to report today, New Holdings, Maruti Suzuki, etc. And the second screening is on the less favored stocks that are expected to miss their earnings in their compared to expectations. And the third screening is the companies that are facing a relatively higher sure interest, but are expected to beat in their results. And the last set of screening are the companies that are facing profit-taking risks, which are having strong 3-month returns, but are expected to miss their earnings results. And also we are monitoring the key bellwether stocks in Asia and EM, and then that haven't reported, for example, Tencent, DBS, and Tokyo Electron. And also we are keeping track of those who have already reported, for example, TSMC, SK Hynix, Reliance, and Ventas. So with that, let me move on to the Q&A session. The first set of questions are for Kathleen. So firstly, on the detail of the 300 billion package, do you have any details on the sector allocation of the investment? And also any remaining overhang on trade deal front after the overnight news?
Yes, so the design of the 350 billion package is, again, divided into two parts. So 150 billion will be all set for investing in the MASCA project, which is the Make America Shipbuilding Great Again. So those investments will be specifically going to the shipbuilding sector, cooperating with the U.S. companies or U.S. Shipyards and the Korean shipbuilders. The details, according to the White House fact sheet, showed that the couple details would be, one was that the HD Hyundai to partner with the Cerberus Capital Management, Samsung Heavy, partnering with the onshore group and cooperate on the naval vessel maintenance, repair, overhaul, and Hanwha Ocean planning to strengthen the Philly shipyards that's already been required since last year and expand the workforce in terms of the production capacity expansion. So there were some details specified for the 150 billion portion out of 350. Now the 200 billion, that's will be the cash investment portion. That details have not come out. Again, it will be the project selected by both the US and Korea together before the investment goes in. And it's the MOU says there has to be a commercially viable project, and it will be the committee, the review committee will be headed by Secretary Lutnick, I believe, so that it's likely that the US will decide which projects to propose to Korea, and then Korea and the US will probably come to an agreement on that. We do think the sectors will highly likely to involve those strategically important industries. It will involve semiconductors, the nuclear power plants, other even the corporation through the critical mineral supply chain related details that we actually just read from the fact sheet relating to refining minerals, or even the separation of the rare earth could be something that the US would be looking at. It could involve some along the line of technology prosperity deal that was signed this time. So that will involve the cooperation on the US AI, exports, biotech supply chain, and also quantum innovation was also specified in the fact sheet. Let me just check other areas. So those investments will going forward will be announced as they come to agree on the each projects. But along the lines, we'll continue to see discussions around cooperation on the military level between the two economies, and also the purchasing of the LNG gas. So the details of the not only investment but also the trade deal itself, we think will continue to come with more updates going forward. For us, again, the most important details from here would be the funding details, how the 20 billion will be raised within Korea through dollar bond issuance or through the utilizing the return on non-Korean won denominated assets, or any other ways that Korea needs to look into. So those funding details will be important. And another, not it wasn't mentioned, but not too minor, would be whether the steel tariff, which is currently facing 50%, whether that could be adjusted downward, I think will be the next step that we will look forward to hearing from the government.
Thank you, Kathleen. We have another question for Jonathan here. So in the report, you mentioned that you will see the non-tech exports to be more critical than tech. Can you explain the rationale of why is that the case?
Yeah, sure. Thanks, Crystal. I think the reasoning is twofold. I think number one is that, tech sector and also tech exports is very fast growing, but at the moment still accounting for a smaller part of the broader economy. So tech exports is about 25% of Asia's export baskets. And if you look at US's entire CapEx spend, IT-related CapEx is still about 20% only of the broader CapEx basket. So it will really be helpful for the broader economy if non-tech side of the economy also picks up. And so related to that is why we think it is critical for non-tech exports to recover. Number two is that tech exports, also in some way related to the first point, is that tech exports do tend to be more capital intensive. So its direct spillover to the broader economy via jobs and also consumption also tends to be somewhat lesser than what you would get from non-tech exports. So I think that's a reasoning as to why we are focusing a lot on the non-tech exports development as it matters for the broader macro outlook in Asia. Yeah, thanks.
Great, thank you. That's clear enough. Thank you, Jonathan. In the interest of time, we'll conclude this webcast here and answer remaining questions offline. Thank you so much for joining us today, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.